Hey everyone, Alex here from Trying True Mortgages. Going to be going over a case study of how to refinance your mortgage. So in this case study, we're going to be jumping into if you have a current mortgage and how to refinance it, and also if your home is free and clear, what it means to actually refinance. So without further ado, let's get into it. So like I mentioned, this case study is going to be on how to refinance your mortgage. A little bit about the content, about what this case study is going to involve, or is going to be involved. First, a little bit about me, if you don't know who I am. What is a refinance? Should I refinance? Example refinance, some closing costs that you need to be aware of, and then the pros and cons of actually refinancing. And then at the end, I'll discuss a little bit about the next case study next week and what we're going to be chatting about next week. So first, a little bit about me. If you don't know who I am, my name is Alex Slate. I am a mortgage agent with Tried and True Mortgages. We're a mortgage team in Hamilton, Ontario, under the Empire Mortgage Group brokerage. And I've been in the financial industry 5+ years now, 3 years as a senior financial advisor with one of the major banks in Canada, and then 2+ years in ongoing as a mortgage agent. A little bit about our team, Tried and True Mortgages. We have over 50 5-star Google reviews and Facebook reviews. And I am a partner of Tried and True Mortgages, along with my business partner, Aaron Porcaro. Myself alone, through my years in banking and in the mortgage world, helped over 250 clients. So we have a good basis and understanding of what clients are looking for, how to help them, and give the most appropriate advice and recommendations possible. So let's begin with refinancing. What is refinancing? What does it actually mean? So I've taken this definition straight from Investopedia.com. They're known for good interpretations and good definitions of all sorts of financial aspects. So I decided to go right through them. According to Investopedia, refinancing refers to the process of revising and replacing the terms of an existing credit agreement, usually as it relates to a loan or mortgage. When a business or an individual decides to refinance a credit obligation, they effectively seek to make favorable changes to their interest rate, payment schedule, or other terms outlined in their contract. And although that summarizes it very well, in simple terms, a refinance just means that you are changing the terms and conditions of your existing mortgage, or if you have no mortgage at all on your home, it means you are adding a mortgage to your home and setting up a new mortgage. When it comes to refinancing, there are a lot of different aspects to it. So I'm going to be going into it in the slides going forward. But just remember that in order to even refinance, you actually have to own a home. When you purchase a home and you are going about getting a mortgage, that's not considered a refinance. That's the initial mortgage process. It's the origination of the loan or of the mortgage. So refinancing is when you change the terms and conditions of your current mortgage, or you add a mortgage to a home that you currently own. Before we even get into some of the other details about the refinance, you should ask yourself the question, should I refinance? Because refinancing is not for everybody, and it's going to be a burden for some people. It's going to be a huge benefit for others. So you really have to know your personal situation. You have to know your financial circumstance and then determine if it's right for you. The three main obstacles or the three main burdens or roadblocks that we see people or that get in the way of people refinancing is the following. First, knowledge. So most people don't even know what a refinance is, admittedly. It's not something that's taught in schools. It's not something that's taught in financial courses. It's just almost like a hidden little secret in the mortgage world, where a lot of people even get refinances mixed up with a renewal. So their mortgage will be coming up to the 3, 4, or 5 year mark, and they'll say, oh, my mortgage is coming up for refinance. That's not the case. A mortgage refinance and renewal are two completely different things. And the result of doing a renewal versus a refinance is going to be way different. So I wrote here, most people don't know that they have the ability to refinance and access their home equity. Refinancing is commonly mistaken for renewing. So I just mentioned that a little further. Second obstacle or objection that we hear is some people are what I call debt phobic, or in other words, they're scared of debt. And this stops them from refinancing or even wanting to refinance. So the idea of just having more debt or even any debt at all scares a lot of people, which is completely understandable because first you're going to have payments. If you miss those payments, you're going to hurt your credit, could go into foreclosure, could go into power of sale, etc. And so a lot of people are what I call debt phobic and don't want to take on any more debt, even if it were to benefit them in the long run. And we'll get into those scenarios about how it can actually benefit you further on. So for most people, the idea of having debt makes them feel trapped. Without proper knowledge and advice, it feels safer to avoid debt if possible. I'll give you an example. Last year, I was talking with a client, an older client, and she was looking to take some equity out of her house just to cover some living expenses going into the retirement years. And we discussed a few different options, and one of those was what's called a reverse mortgage, which is technically a refinance because you're taking equity out of your house. Although she didn't have a mortgage at the time, a reverse mortgage would be a refinance. And she just didn't end up wanting to go through, or I guess the problem she was having was the cash flow issues and a little bit of expenses that she is going to expect in retirement. And so we looked at her budget, we looked at all of her financial, her whole financial scenario, and it just made sense to pull some sort of equity out of her house as opposed to selling the house and then getting that money in her hand, but then she would have to live somewhere else. Fortunately, she did not want to end up going with the refinance or the reverse mortgage, which is completely fine. Everyone has their opinion and decision to do so. But this is a client I would put into that debt phobic or scared of debt. She just couldn't understand why she would be taking on debt to cover some of those expenses. And that was sort of the end of the scenario. So there are people like that. And if you're one of those people, I completely understand, because even myself, I don't love having debt, of course, but there can be cases where it's super useful. Third obstacle or objection is no home equity. So you might not be in category 1, or you might not be in category 2. You might be in category 3, where is you're not afraid of debt, you know what a refinance is, but you actually, you actually don't know, you don't have the home equity or even the ability to pull out any equity in your home. And so what I mean by this is, let's suppose you had a $500,000 home value, and you had a $400,000 mortgage on your home. That's already 20% of the home value. In other words, your loan to value ratio, you divide 400 by 500 and you get 80% loan to value ratio. You can't go above that 80% in any circumstance in Canada, unless you're a first-time home buyer or just buying a home outright with less than 20%, but that's a completely different scenario. With refinancing, you cannot go above the 80%. And so there's actually no home equity available to refinance. So what I wrote here is, if you've owned a home for a short time period, it's unlikely that the home equity has increased enough for you to access the cash locked in your property. So like I said, exactly, if you're already at that 80% mark, you're not able to take out any extra money. However, let's say you did own the home for the last 10 years and you bought it for $300,000, now it's worth $500,000. Even if you have a mortgage on there, it's likely you have some home equity available to be able to refinance. So these are the 3 main obstacles we see to refinancing. Knowledge, most people don't even know what it is, what refinancing is. Second is debt phobic, where people are just afraid to refinance, which is completely fine. I understand where they're coming from. And then third is just no home equity. So even if you're not in category 1 or 2, you might be in category 3 because your home hasn't increased in value, or even potentially may have decreased, depending on what's happening in the market at the time of watching this video. Moving on, let's go right into an example refinance. First, I'm going to outline the 4 steps that you need to know. So there's 4 steps in any refinance. And then I'm going to actually go right into a refinance scenario with calculations and everything to give you an idea of what you should be aware of and how a refinance could benefit you in that specific scenario. First, step 1, before you begin any refinance, you should chat with a mortgage agent to assess and discuss your current situation. What I mean by this is, like that third type of obstacle, it's best to just talk with somebody like myself or the agent that you know that's local to you, because they're going to be able to identify any issues you might run into or any roadblocks that you're going to run into before you even start the process. So they're going to assess what you currently have for a mortgage, or if you don't have a mortgage on the house, your current income, the approximate home value, credit score, debts. And then from there, they should be able to give you a good idea of what you'd be looking at with a refinance. And then after that, you're going to jump into step 2. But first and foremost, you got to have that phone call. You got to get a little bit of knowledge, find out if it's even a possibility, and then you can proceed to step 2. Step 2 is your agent is likely either going to take your information via telephone and start the application that way, or they're going to send you an application link where you can fill it out on your own time. Either one is fine. It depends really what your preference is. A lot of people like to do applications on their own time via email now, because it takes time to fill it out, and they want to fill it out to their best ability on their own time. So what I wrote here, you're going to work with your agent to begin your application and provide them the necessary documents for your income and property. In this step, you're going to need a few things or the agent's going to need a few things from you. First, they're going to need income documentation. If you are going through an A or a B lender and we need to verify your income, we're going to need things like your pay stub, potentially a letter of employment, potentially tax slips, tax returns, business bank statements, depending if you run your own business. So those are all things they're going to ask for in order for the lender to get you approved for the mortgage. We are probably going to ask also for property taxes. If you have a recent property tax bill, we're going to ask for property insurance. We want to make sure that your house is covered in the case of a fire or a flood or hurricane, whatever the case. And then they're going to ask you for things like a void check, identification, etc. Moving on to step 3, this is where you're going to actually review your options. So after you've provided everything to your mortgage agent, they are going to submit to the lenders. And then once they submit to the lenders, they're going to get some options that are available to you in your specific situation, and try to do their best to give you the most advantageous options. So for example, I'm working with a client right now, a self-employed individual. They're looking to refinance their loan, just move. Funny enough, they're actually up for renewal, but and it's not necessarily, it is a refinance, but they're up for renewal at the same time because they want to take a little bit more money out of their home. And so the individual gave me all their documents. We were able to go to a few different lenders, get them some options, and then I laid out the different options for them and what is available with their current home equity available in their home. So you're going to review these options and then make the best, most informed decision possible for you. Of course, your mortgage agent should have some sort of input on this as well, because yes, as a consumer, you're going to know the ins and outs of your financials, but at the end of the day, the mortgage agent is a professional in this industry, and they do this every single day. So they should show you, payment breakdown with property taxes, with home insurance, estimated utilities, all those things, so that you can get an idea of what to expect. I wrote here, your agent will bring you potential mortgage options, as well as telling you the terms and conditions of each option. So it's really important to know those terms and conditions and for them to walk you through it, because you want to make sure that you're making the correct decision. Step 4, and this is really just the last step, Steps 1 to 3 are during the process, and then step 4 is just waiting for the closing date. So I just wrote here, finalize all outstanding conditions for your refinance, including financing, legal, and payout logistics. So the financing would be if there was any documentation that you still needed to provide to the mortgage agent. Legal would be you need to provide your lawyer's information to finalize and execute the refinance. And then payout logistics is, let's say you're using the refinance to pay out some debt. In that case, you need to provide either your agent or the lawyer with recent credit card statement or recent line of credit statement, recent car loan statement, etc. So let's give an actual example of what a refinance is and how it can benefit you in an interest rate scenario. Okay. So this scenario I did is for one of the benefits of refinancing, which is to refinance your current mortgage so that you can change the terms and conditions and get a better interest rate, save on your monthly payment, and also save on the amount of interest you're going to pay in the term of the mortgage. So in this scenario, there's a few different variables. So the variables on the left-hand side here, we have your mortgage balance, interest rate, amortization, mortgage payment on a monthly basis, and then the interest paid over 5-year term. So we chose a 5-year term. Your term might be 3 years, your term might be 1 year, but we use a 5-year because it's the most common term, and it's a fixed payment, so not a variable rate interest rate. So mortgage scenario 1, we're going to have a $500,000 mortgage balance, 6% interest rate, 25-year amortization. In both these scenarios, I didn't mention it, but the term, like I said before, is just 5 years. The amortization is 25. So with those variables, your monthly mortgage payment is going to be approximately $3,199.03, and the interest paid over the 5-year term is $141,125.57. Moving on to scenario 2, and this is where we get the benefit of the refinance and reducing your interest rate. So scenario 2 is, again, $500,000 mortgage. We did apples to apples here just to show what it would be on an even basis, but your mortgage might actually increase a little bit if you refinance and take some money out, but that's for a different scenario. In this scenario, you went from a 6% interest rate to a 4% interest rate. So interest rates are falling at the time of watching, not at the time watching, at the time of refinancing. So you were able to benefit from lower rates. We're going to leave the amortization the exact same, just for apples to apples. Again, your amortization might actually be 21 years or 22 years, and you might bring it back up to 25. It's up to you. You'll see here that your payment went from $3,199.03 down to $2,767.36. So quite a bit of difference. It's actually a $431.67 difference. So $431 per month is a car payment, an entire family phone bill. It's your utility bills for the month. It's your credit card payment for the month. Whatever it is, that's quite a bit of money just on a monthly basis from saving the 2%. This is where it gets even bigger and I think more significant. You don't see this up front like you do your mortgage payment on a monthly basis, but over the 5-year term, this is where you see this. Your interest paid over 5-year term goes from $141,125.57 to $93,075.71. In other words, over the 5-year term, you've actually saved yourself $48,049.86. So again, let's put this even in a different way. You've saved yourself a vehicle in a 5-year term, a $48,000 vehicle over the 5-year term just by refinancing. The caveat here, because this is a huge benefit in what we're doing here, in this example, but there are going to be some caveats, and there are things that your agent should make you aware of, such as any fees and prepayment penalties, and then the risk of just potentially adding debt if you're going to add debt, or just extending the amortization back out. So let's just even use an example. Let's say your prepayment penalty, this is going to be high, but I'll use it as an example. Let's say your prepayment penalty was going to be $20,000. You would still save, you subtract 20,000 from this amount, you would still save 28,000. So as opposed to an SUV that you're going to be buying, you're going to be buying a sedan in savings. So keep that in mind. This is one scenario about our interest rate reduction. There are other scenarios such as debt consolidation, and I'm going to get into those in a little bit. But this is the scenario I wanted to go with, just to give you guys an idea of what you can do. Okay, closing costs. So with any refinance, like any real estate transaction, you're going to have some sort of closing costs. And I mentioned these a little bit earlier, but I'll continue with them here. First, you're going to have just in the application, you're going to have some costs associated with the application. You're going to have your legal costs. So the legal costs are your lawyer doing the lien on the property, the charge on the property, setting that all up for you, doing your title insurance. Generally, refinances are a little bit cheaper than home purchase. So you're going to see in Canada somewhere between $800 and $1,500. And then your appraisal fee. If you're doing a refinance and changing your mortgage altogether, let's say you're going to be with an A lender, you might not have an appraisal fee because they might be able to do what's called a desktop appraisal. But most of the time, you're going to have some sort of appraisal fee. And these generally range from $300 to $500. And unfortunately, over time, this cost just seems to be going up. So there's really no way around that if they're not able to do the desktop appraisal. Second, you're going to have prepayment fees. So I actually mentioned this in that example. If you are paying out your current mortgage before the renewal date, you could have some fees. If your renewal date is 5 years away, or if your renewal date is 3 years away, you're going to have some sort of fee. It's just the rule of thumb is the longer the time until the renewal date, the larger your fee is going to be. And also, generally speaking, fixed rates, the larger the difference in interest rate percentage saving, the larger your fee is going to be as well. But this is why your mortgage agent has to do the calculations for you, because even with a prepayment fee, if you can get that interest rate down 1 or 2%, in the 5-year term, it might save you in the long run on total interest paid. So that's where they have to do that calculation with you. And then lastly, another closing cost is lender fees. So if you're obtaining financing through a B or private lender, you'll pay some lender fees at closing. And so what I mean by this, if you're with a B or private lender, generally the lender is going to charge a 1% or 2% fee. We've seen fees for privates go all the way up to 5%, and you pay their legal costs. So just bear that in mind. If the refinance isn't going to help you after those fees, make sure you put that into calculation. But just you got to calculate those fees into that long-term saving of what you're looking to do. Okay. Moving on to the pros and cons. So let's see here. How am I doing for time? Okay. Pros and cons of refinancing. So I did 3 pros and I did 3 cons. I'll start with the pros. First, I mentioned this earlier. If you can get a lower rate, it's going to lower your payment. So you're going to reduce your payment and interest rate when interest rates decrease in the market. If interest rates were 5% when you got your mortgage, but now they're 3%, it's probably a good consideration to look into refinancing. Second, you're going to consolidate debt and help your cash flow. So this is the second, probably the most significant purpose of refinancing. You're going to lower your monthly payments, and increase your cash flow. This helps to reduce stress and help you pay for other things. So for example, let's say you had that $400,000 mortgage, your property value's where it needs to be, it's much higher. But you have a $50,000 unsecured credit card that's 19.99%. You might want to refinance that into your mortgage. and bring that 19.99% down to 5% or 4% or even 9% is better than 19.99. So that's going to increase your cash flow for sure, because your monthly payment is going to reduce and going to be actually completely gone from that card. And lastly, the biggest benefit I would say, or the last of the biggest benefits I would say, is you can access cash when you need it. So refinances help you access cash locked in your home and cover expenses, help with investments, and more. A lot of people potentially want to invest in another real estate property. You could even potentially invest in the stock market, invest in your private business, your self-employed business, but you don't want to sell your house to get access to that cash. This is where a refinance can come in and help you acquire money that's locked in the walls of your home, and be able to use that money to stir up and create other money in the long run. So these are the three main benefits or pros that I would discuss with my clients about refinancing. And now we'll get into the cons, because there's always generally drawbacks with every single transaction, but you just have to weigh the pros and cons. Major cons. Mentioned this one earlier, and they're actually very similar to what I mentioned earlier with closing costs. Prepayment penalties. So if you are breaking your mortgage early, you will have a prepayment penalty that has to be factored into the calculations. I talked about that earlier. When you're going from a really high interest rate to a really low interest rate, or you have a lot of time left in your term, your prepayment penalty is going to be big. It's going to be large. So the interest rate savings has to be there. You have to factor that into calculation, because you don't want to end up actually going negative, unless you're looking to do the refinance for other cash flow purposes. Second, lender fees. You got to watch out for these guys. There's really no way around it. If you're going with a lender and refinancing your existing mortgage and not going on as a second mortgage or just adding a new mortgage, then you probably won't have a lender fee. But this is something you have to watch out for. So I just wrote, with many refinances, there are no fees, like I said, with the A lenders. However, if you need a B or private lender, you will have lender and broker fees. So on top of the lender fees, as a broker, as a real mortgage agent, we don't get paid by the lender for B and private mortgages. So we do need to have some sort of compensation for giving you access to that capital, helping you through the process. So the brokerage generally will charge a 0.5 or 1% fee as well. And then lastly, debt risk. So this one is pretty significant, because even if you are really good with money, even if you're looking to do the refinance, let's say to benefit you in the long run, whether it be reduce your monthly payment, reduce interest paid, invest in another property, you have to realize you are still taking on debt. And so taking on, like I wrote here, taking on any new debt, increasing your amortization, or using home equity for investing can be risky. And we have seen it before, where people were in a variable rate mortgage and they took that money out and used it to buy another investment property. Well, the variable rate mortgage shot up in interest. And so their monthly payment, now they were majorly in the negative, and it was causing a whole bunch of other problems. So you have to be aware of those debt risks, and do your calculations accordingly. So with that, it brings me to the end of the case study for refinancing. What is a refinance? Thank you very much for joining me. If you have any comments or questions, leave them in the comments section, or direct message me on any of the social medias. I'm pretty much on all of them. My next session is going to be next week. We're going to be going into what is a mortgage, and I'm actually going to do a deep dive into the ins and outs of mortgages, give a mortgage example, give some tips and tricks on what to watch out for specifically with a mortgage, and really just try to encompass everything that has to do with a mortgage and what you should know. So thank you very much for watching. I really appreciate it. Like I said, any comments, questions, concerns, direct message, or leave a comment in the description. And I hope you have a great day. Thanks.